Well, it means three things. One is that this new agreement shows that our economic competitors, like the European Union, are moving faster than ever to strike new deals. This is a third of the global market. It's the largest pact that's been negotiated since the original Trans-Pacific Partnership when the U.S. was part of it. And we see that the EU is rapidly negotiating agreements with Canada, Mexico, Australia, Chile, Indonesia. So there's a huge expansion in number of trade agreements. Secondly, the U.S. has largely retracted from negotiating trade agreements. And third, we're also involved in heavy litigation for the U.S. within the WTO. So it's really a dramatic contrast between the expansion of new trade agreements by our economic competitors and our allies and a real retraction from the United States.
We have talked an awful lot about the tariffs, and that's certainly something that we've heard not only from investors with some concerns, although the markets are still doing quite well. Yesterday, Senator Heidi Heitkamp brought up her concerns about what it's meant for farmers in her state, some of the short-term pain, in conversation with Jay Powell, the head of the Fed, who said that tariffs are certainly not the right direction over the long term. What's the best case and worst case scenario here?
Well, the best case scenario is that the tariff taxes that the U.S. is imposing can create some change, particularly in China, which is at the heart of the major problems that the U.S. and much of the global economy faces because their system is not open and because of their policies. The worst that could happen is that these taxes that the U.S. is imposing become the norm, that they stay in place. There may be short-term adjustments in the market because the economy is strong, but long-term what it means is that there's a real defensiveness and a withdrawal that would make American goods in foreign markets more expensive. And I think that's the real risk in this. We really see this huge dichotomy that's happening, where the rest of the world is trying to reduce tariff taxes, expand their market opportunities while the U.S. contracts. And that long-term cannot be a good position for the U.S. to be in, whether it's the tariff taxes we're putting in place or simply walking away from the expansionist trade deals that all of our major allies and competitors are engaged in.
Let's focus on the best case scenario for a moment. You bring up this idea that China has not played fairly. I mean, it was accepted into the World Trade Organization. Was that a mistake to allow them in when they still had all of these constraints?
Well, look, I actually think the premise of that question is in some respects revisionist history. I mean, there's a lot that's changed. There were certainly expectations on China at the time they entered the WTO that they've not lived up to. On the other hand, China is now the second largest economy in the world. It would not make any sense for China, the second largest economy, to not be in the WTO. So what we have to look at is, one, whether or not the WTO can work. Two, are there gaps that need to be filled in, which in many cases do not have to be filled in by the WTO. They can be filled in by new trade agreements. And certainly these type of agreements that we see that Japan's entering into with the EU and with the rest of the TPP countries is in part a counterpart to what's happening in China by putting new rules and modern rules in place that would be difficult for China to meet. So there are a couple of ways to get to this. Right now, the U.S. has largely walked off the stage. That's neither good in the short term, and it will be terrible for the U.S. in the long term.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.